Hello, this is Tyler coming to you with Socrates Investments, and today I will discuss a topic that applies to everyone here. What's liquidity? Liquidity is your ability to buy or sell a stock at a given price, and this is also applicable in non-stock areas also. In an ideal world, we'll have two companies here. We'll have Coca-Cola and Intel, two very well-known companies that are traded on the stock exchange. We have 100 shares of Coca-Cola and we're selling for $40 a share. With this, we'll get about $4,000 capital gain. Intel, on the other hand, is selling for $24 a share and will sell 100 shares for a $2,400 gain. Now, in these two situations, it's likely if you were trading their stocks, you would get this exact price or something very similar. And why is that? Because these two stocks are very high liquid stocks, and it's very easy to find buyers that will snap up those shares. Most of the very well-known blue chip or major S&P stocks will always have buyers interested, and there's just a very high flow of buyers and sellers. Now, on the other hand, where there's penny stocks that are much less demanded, and likewise, it's much more difficult for a seller to find someone who's willing to buy at their demanded price. If we look at an investment, it's very important to measure liquidity, and stocks are one of the most important. And as was stated, liquidity measures the buyers and sellers and the relative demand for the asset. An asset can have high demand but low liquidity. And an example of this would be like a certain Vincent van Gogh painting or a certain type of artwork. High demand but low liquidity. On the other hand, there's other things such as gold or silver or bonds that are very liquid and likewise very easy to exchange for cash. Now, the general rule, the closer an asset is to cash, the more liquid it is. And this is known as the money market. It's now stock liquidity varies based on multiple levels, and it's not the same for every kind of stock. Liquidity also has a time component to it, and how much time elapsed between the seller offering the asset and the buyer accepting. A blue chip on the Dow will have a lot of buyers and sellers, and finding a buyer at a given price is much easier. On the other hand, a penny stock will have much less buyers and likewise can be very hard to find a certain price because penny stocks typically don't have a lot of liquidity. This is one of the worst flaws of penny stocks. Prices may look great and you may see what appears to be a wonderful opportunity, but there's just simply not a lot of liquidity. There's not a lot of buyers, so the price demanded often will have to be reduced quite a bit. And liquidity matters not just for stock investors, it matters in other kinds of assets also. The more liquid the asset, the more likely that you can buy or sell it for a certain price. If you're investing regularly, it's very good to keep some of your assets in more liquid form. Having like treasury notes or bonds, gold or silver, and of course stocks are very important to help balance your portfolio. And also remember that liquidity is important, but it's not everything. Low liquidity doesn't mean that you cannot sell an investment. It means that you may have trouble selling it at your current price. And the more you discount the price, the more liquid you make the asset typically. And it's great to measure liquidity for selling, but there's also other factors that play in here. And it's important to just understand this as one piece of the equation in a big puzzle.